right, welcome to this episode of the Living Vote Connect podcast. Today, I have my guests, Derek and Michael from Northwestern Mutual Wealth Management Group. And guys, this is the first episode of this podcast.
That's awesome.
So, you're my first.
Super excited to be
Don't
here.
be too nervous.
The guinea pigs.
Yeah.
I love it.
But I'm excited about this podcast that we have today. It's probably one of the more important ones that we're going to be sharing. Now, all of them will be very valuable. But again, I feel like today's topic is just going to provide so much value, especially to a lot of our agents who are self-employed, independent contractors. So obviously, we're talking about wealth management. And one of the first things that I want to talk about is just retirement savings accounts. And, you know, what kind of options does somebody like myself who is an independent contractor, self-employed, what do we have available to us?
Yeah, that's a great question. I think there's really 4 primary accounts that's available out there. The first is one that's pretty well known. It's a traditional IRA. So what a traditional IRA lets you do is invest, save money into potentially a tax-deductible account. And then that money grows tax-free. And then you can take that money out in retirement starting at 59.5. Now, at that point, you're going to have to pay taxes on it at income tax rates in the future. The second option really is a Roth IRA. If you're under certain income limits, you'll want to look that up online and talk with your tax professional. If you're under those income limits, you can contribute to that. And that money is contributed after taxes. At that point, the money is growing tax deferred, and then you can take that money out tax free, even the gains at that point, which is really exciting when you're retired. The other 2 options are more for self-employed individuals. So the first is a solo 401k. What that allows you to do is open up a 401k even as a self-employed individual. And this year in 2023, the contribution limit is $66,000 that you can save or invest into a 401k on a solo basis. The fourth option is going to be a SEP IRA. And with the SEP IRA, what that allows you to do is actually put 25% of your income, or I think the limit this year is $66,000 as well. You'll have to double check that. But what's nice about that one is you don't have some of the administration costs and overhead that comes with the solo 401k. So all those options are great. It's something to consider if you're looking at saving money for retirement.
Yeah. Conceptually, when you think about should I go traditional or go Roth, it really depends on the nature of your situation. What's our income situation this year versus where it's going, how we feel taxes are now versus how they are in the future. Taxes historically are very low today and could be climbing. And so depending on how we feel about our situation is something that individuals can talk about with their advisors. What is their unique situation? Because it could vary, but however, we do have a fear of the unknown risk of what is the tax burden going to be for us in the future versus we know what it is today.
Sure.
Right? We can't predict though the future risk.
Yeah. I'll just want to correct the 401k. It's not $66,000. It's around $26,000. The SEP IRA is $66,000.
Okay,
Yeah.
Which still significant numbers
Still significant.
compared to like some of your traditional retirement accounts.
Exactly, yeah.
So let's talk about that. You hear a lot about the Roth, you hear traditional retirement accounts. What's the difference between those two?
Great question. Really important question. So the traditional, what that really is a pre-tax contribution. And then the Roth is an after-tax. And you'll hear those words interchangeably, so it's sometimes going to get difficult to catch up with what's actually happening. Pre-tax is a great way to save some taxes potentially today, because if you make a contribution and it is tax deductible, you can obviously take that deduction for that tax year. Now, it comes at a price and a cost, because in the future, with that traditional contribution, because you haven't paid taxes, the IRS is going to say, hey, you're taking that money out in retirement. We haven't gotten our taxes yet. We're going to start taxing you on that money. The Roth, the difference there is you pay the taxes up front. So you pay the tax today. That money is then tax deferred, and then in retirement, that money is tax free, even the gains. So it depends on the individual situation, but certainly it's really important to evaluate how you're doing that, because it can cause some tax trouble today, but also in the future.
Gotcha. I'm a visual person, so sometimes it helps to have something to relate it to. We say tax on the seed or the harvest, right? You're getting taxed on the seed with Roth contributions, and your harvest is tax-free versus You don't get taxing your seed with traditional, but you have to tax your harvest
when you get it. Yep, I love that. I love visuals as well. So obviously, we're the people that are watching are in the real estate industry.
Yeah.
And you hear a lot about, well, you should invest in real estate. Invest in real estate. What are your thoughts on, that kind of the pros and cons of staying out of the stock market and just investing in real estate?
I'll let Michael take this.
Yeah, I mean, listen, I think one of the biggest things that we typically hear, and we hear it from real estate professionals everywhere, it's like, oh, my client went, talked to their advisor, and they said, don't invest in real estate, let's just invest in the market. And that's a very sort of non-abundant answer. The reality is everyone's situation is unique, and if someone's plan is to build a real estate portfolio, there should be a plan around how to do that effectively, right? And when it comes to investing in the market, there's a plethora of things we can be doing with real estate. There's a few things we have to be consider, right? And what are the pros, what are the cons? There are sort of a non-correlation in some degrees with real estate versus investing in the market, and so that could help diversify your portfolio a bit. And one of the sort of main cons is, however, over concentration. I mean, we do find that to be a situation with some of our clients where they are overly concentrated in one or two areas. Sometimes it's not real estate, it could be anywhere, but with real estate specifically, and maybe not set up well enough to be protected on the downside, right? Do we have cash reserves? Do we have things in place to protect against, a changing economy?
Mm-hmm.
And that over concentration could be a challenge. We often hear too, everyone would like to have a rental property, right, of some degree. And that's a great strategy to create some passive income along with other investment strategies. But are they aware of what it takes to manage one, deal with tenants, deal with broken appliances and all the things that go along with that? So is it passive income or is it real estate that the person's interested in? If it's real estate, great. Let's put a plan around that. If it's passive income, maybe they're best suited to go a different direction, right?
Yep.
Yeah, just to add that a little bit more, we find, in my personal experience, I found a lot of times it has to do more with just knowledge and education around what's happening in the market. And obviously people in real estate know real estate a lot more. So you invest in what you're comfortable with. And so that's why really we have a passion for working with people in the real estate space, is to provide that education and thought partnership around investing in other areas. Now, we want people to invest what they're comfortable with and what they want to do. Our biggest focus is always, what's the goal? Mm-hmm. And if our client's goal is to accomplish buying real estate, how can we help them accomplish that more effectively? But also, it's always good to diversify some of your assets. You don't want too much concentration in one particular asset class. And real assets like real estate is one of those asset classes. We do want exposure elsewhere because real estate can be a very localized market, right? Real estate can be positive one area, negative another area. We could have a hurricane blow through, wipe out rental properties like it did for some of our clients last year. And so we do want to make sure there's other areas. And then from a tax perspective as well, like we talked about with the pre-tax and after-tax, there's a lot of tax advantages to having your money in a retirement account. And so we're not saying let's do one or the other. Let's diversify away. So,
yeah, and that makes sense. And, you both said something that really hits home. How the economy is playing out really has an effect on all of your retirement accounts, your savings, your plan for the future.
Yeah.
And so diversifying is something that's very important. So let's expand just a little bit more on really what it means to be diversified.
Yeah. So diversification, really what that means is that you're not holding all your eggs in one basket, right? We've all heard that saying before. And the most important part about that is that the basket that you have, all the eggs that you have, is wide and far reaching, right? Mm-hmm. So diversification, for example, just to give a real estate analogy, would mean that you're diversified across not only the Sarasota area, not only the Florida area, but across the United States, maybe across the globe, right? How diversified is it really? And so when it comes to our
commercial, residential,
when it comes to us building a wealth plan for a client, it's always about considering the bigger picture.
Sure.
And considering, okay, do you have exposure in all these other areas? Are they correlated to each other? Meaning, are they usually moving in the same direction? Or are they working in opposite directions? Because we actually want some assets that work in opposite directions, meaning that when the market's positive, when that market's positive, maybe it's negative, and vice versa, because that means that we're actually balancing out the risk. So what happens in a diversified portfolio is that, you're never really going to achieve top category returns, meaning there's always going to be an asset class that performs the best in a given year. But the goal of the diversified portfolio is to always hit the middle as much as possible, right? Where it's always going to be a little bit more steady, more stable, not the bottom, not the top, but consistent over time. That is the goal of a diversified portfolio.
Okay. And, there are 9 asset classes, right? Large cap, mid cap, small cap. You have commodities, you have international, emerging, and developed companies. You have real estate, you have fixed income. So real estate is a component, one of those 9. But the percentage of where it should be fitting into the portfolio could be overbalanced or underbalanced based on the client. And so our job is to help make sure that we're trending in the right direction to create that stability long term.
Okay.
What we don't want to see in someone's portfolio is there's a super overbalance in one area, which is giving them undue risk for not the right amount of return, right? Do they have the right reserves or protections in place to allow them to take those additional risks?
Gotcha. Okay.
And by doing the right diversification, it does allow a lot of our clients, especially the ones who love real estate, to take those additional risks when they want to buy a new property or leverage out to extend their reach into a new market. And so if we plan around the financial side of it, it gives them that opportunity to take advantage of what's available.
Okay. So to go on top of that, with a client that you meet and they have, specific goals, I guess what is recommended is based on their ability to take on risk.
Yeah.
Is that fair to say?
Yeah, great question. I mean, everyone's, when we're talking about investing, everyone's individual. That's why we always recommend consult with your own financial advisor, financial planner. But certainly when we're thinking about diversification and risk level, we'll do what we call an investor profile, which is just to understand someone's appetite for risk, really. And sometimes it's surprising because, you could go in like, yeah, I don't mind some risk. And then you take the questionnaire and you're like, wait, I'm actually more of a balance in that.
Yeah.
Or like risk averse.
Can't stomach the upside.
Yeah, and can't stomach the volatility. And that's okay, right? Everyone's on a different place on the investor profile, and that makes sense. And so that's how we tailor a plan. And that's really how, and everyone's personal planning, right? Talking with a financial planner, going through that type of exercise can be helpful.
And that's, I think, one of the steps, right? You have, where's my appetite for taking on risk or investing in a property or a business or whatever it might be, right? Or even just the stock market, right? Or the equity market. But then there's one step further, which is, am I positioned to actually do that investment? Can I take this money and put it into one of these assets? Am I protected against other things? Do I have cash reserves to weather a storm, right? Because I may have the appetite to take on large risks, but I'm not really financially set up to do it. Yeah. And that's the other piece of it. One of the things we focus on is allowing our clients to have the opportunities for advancement, right? Versus gambling with their money. And so when we think about, market corrections like we experienced just this last year, 2008, any other big correction you've experienced, right? Do I have the capital resources available to take advantage of an opportunity like that, right? I can't predict them, right? That's all just guesswork and luck at the end of the day. But if I'm positioned well to then, hey, I know we're in a correction now and the market's down, real estate's suppressed or whatever it is, I can now go buy properties because I'm positioned to do so versus just guessing when it's going to be the right time. Yeah. And so that is another piece of it. May have the appetite for a lot of risk, but is it the right time? Right? And then prepared for it. Those are the next step, in good planning.
Yeah. All right. So speaking of next steps, so in real estate, there's risk, there's volatility in our income, right? Some years can be great. Some years, maybe not so much. Yeah. But let's just say I have all my accounts set up and I cap out on everything. From there, what else can I do if I have a significant amount of income that's just sitting there waiting to be taxed?
Yeah, that's a great question. So I think some of the areas that you could look at is, okay, really go back to your goals and say, all right, what were my goals for this year financially? Have I accomplished all of those? And if you have, awesome. That's a great thing.
Yeah. Kudos to you.
Then it's like reevaluate what those goals are. But usually there's something, right? Maybe it's more of one of those bucket list things like, that you've always wanted to do financially. And that's maybe where that money could start working towards, right? Maybe it's a larger trip that you wanted to do. Maybe you just need to add some money to emergency savings. Maybe there's like a debt that needs to get paid off where it's like, okay, I wasn't going to pay that down this year, but now I have the ability to save some money on this interest cost. Let's pay that off. And then beyond that, right, it could be investing outside of a retirement account, whether that be an investment portfolio, or maybe there's a real estate purchase goal as well. So it always goes back to really what's the goal at that point. And if you're doing all those things already and you're needing to go to those like secondary type goals, that's awesome. That's a win.
Yeah.
Yeah.
And I'm assuming if you're in that situation, it's reach out to your financial advisor, let them know where you are, what you have to invest, and they can figure out what the best option is.
Yeah. There are other strategies too, and this is where people have to be careful because there's a lot of noise about this on TikTok and Instagram and about insurance strategies to help defer taxes, and those are real strategies, but not all of them are the best.
Or right for the individual.
Or right for the individual. And in general, there are certain strategies that really don't make sense for most people, but they're sort of sound great, right? People try to market to you, or they're not really regulated well. So people do have to be careful when you're sort of getting a message on Instagram or TikTok and you don't really know who the person is and they're trying to pitch you this idea. But yeah, there are other strategies. If we're maxing out on qualified plans, there are insurance strategies that allow you to defer taxes, can be leveraged in the same way, and have advantages, but they're also sort of not great versions of those strategies out there.
Yeah, I would just say lean into the financial planner or the fiduciary that you're working with and really have those conversations, because that's an awesome life goal, and they're going to want to celebrate that with you, right? If you've already done all the things that you're like, I'm 8 months into the year and I'm crushing it, what else is next? Then that's awesome.
Yeah. Yeah, and I've seen the some of the marketing gimmicks on social media, and it's you really do need to look behind. Okay, who is this person? Just a week ago he was selling cars, and now all of a sudden he's this insurance guru and financial advisor.
Yeah,
lean on your professionals, right?
Yeah.
But since you brought up insurance, all right, so one of the key things with our industry is, again, we are independent contractors. We're self-employed. I get hurt, I can't work, I don't get paid. So what options does somebody like myself have to protect themselves in that case?
The reality is a lot of people that start off don't really think of themselves necessarily as a business, think of themselves as a person. And we're just getting started, right? And so I'm a person and I'm going out, going to sell some homes or some properties. And then we start creating income for ourselves, and we think of that as income versus revenue. So we have to think of that as this is a business, this is revenue. How am I protecting the revenue of my company, and then protecting what I'm paying myself as an employee of my business, right? And so we don't have benefits as a non-corporate employee. We have to build those for ourselves. And you brought up a really good point. We don't think about this. We all feel indestructible. I know Derek and I, I'm sure you do as well, feel pretty young and healthy, and hopefully it stays that way, right? But the reality is that we're far more likely to get hurt or sick than die prematurely. And we have tons of people in my life that are just unable to really work as hard as they could have because of something that occurred. Could be cancer, chronic illness, car accidents. They just have stopped them in their tracks and really diminished their capacity to grow the world they wanted to grow for themselves or their families. And so, yes, we do have to think about protecting that income stream. It's income, especially early in life, is really our largest potential asset, right? If you took that number, whatever your income is, compounded annually by an inflationary rate over the course of your working years, it's going to be probably a pretty significant number, probably most likely in the millions if you're doing okay. It could be tens of millions of dollars if you're doing pretty well. And so, yeah, protecting that through disability coverage individually and also your business as well.
So disability insurance allows you to still earn, well, not necessarily earning, but you're getting a paycheck from that disability insurance when you're not able to work.
It's replacing the income you would have created, some portion of it. You never cover more than you make. You really can't exactly quite because they want you to go back to work ideally, but you can cover a pretty good portion of it tax-free to yourself that I'm not working. I do have a paycheck coming in, pay my bills, which probably will be larger than normal because of medical expenses or some care needs. To help make sure that, one, bills are paid, but hopefully also some savings can still maintain. The unlikely event that somebody would, stay some sort of disabled for a longer period of time, there's going to be some savings diminishing, there as well. And that's going to affect their long-term goals, financial independence, retirement, legacy goal, things like that.
Sure.
I'll just lean into like the feeling like Superman argument where it's like, hey, I'm not going to get sick or injured. Northwestern Mutual actually just came out with one of their studies, and what they found is that 1 in 4 people in their 20s will become disabled before 65.
Really? Wow.
Yeah. So it sounds like a large statistic, and it really is. And disabled doesn't mean, you're going to be unable to get out of bed every day for the rest of your life. It could just mean that you're going through a trial or a time period where you're just not as healthy as you were, and you're just not able to do the same things for a period of time because you're having to go through this health trial in your life. It could be a year, it could just be 2 years, and then you're back on your feet again. But that year or two of lost time means that you weren't saving money, that you weren't building your wealth. Maybe you're actually going the opposite direction. And the point of disability insurance is to step in and say, you know what, I'm at least able to stay at the same point, or maybe even able to build a little bit further towards my wealth plan and my goals rather than taking a back seat.
Yeah.
And that's the last thing we want any of our advice to do, is taking a back seat to their planning.
And that's why I wanted to bring that up, because I think that's so important that you have that backup just in case. And that's exactly what insurance is for, right? Just in case X happens, I'm going to be protected.
And it's really overlooked as a whole. And look at all the people we service, other than doctors and attorneys who are sort of coached into it early on in their careers to get disability coverage. Most others are not. And because they all feel pretty indestructible. But the reality is, if, you cover your car, you cover your house for a total loss. If you look at your total loss of income comparatively to what it costs to do the coverage for disability, it's a very small percentage.
Yeah.
But it feels like a lot. It's an added expense for things that we feel like, oh, I don't really know, so I need that. I feel pretty healthy. But I mean, there's 4 of us in the room with our support team here, and she has one out of 4.
Oh,
it could be one of us, right? And I'm not.
we're gonna note this date down.
I'm not taking that chance, right? So, yeah,
Challenge accepted.
Yeah.
So no, that's great, guys. And as we wrap this up, so I appreciate your time, because I think one of the things that I really want to make sure, agents know is that you hear the Roth IRA, traditional IRA, but there are plenty of other options to prepare for your future, to set yourself up, to be, financially well off or wealthy, whatever you want to call it. But you have to start. And that's the biggest thing. I see so many independent contractors, so many self-employed people not doing that. They're waiting, and they wait, and they wait, and they wait. And then eventually they're like, well, now it's just too late.
Yeah.
So on that note, I've got hopefully a fun question for you. Knowing what you know now, if you had to go back in time and you went to little Derek and you went to little Michael, what would you tell your younger self?
Yeah.
Well, that's a great question. I would tell my younger self to start a Roth IRA at 18 years old. When I was working at the YMCA and GT Bray pool as a lifeguard, I would have started maxing that out back then, because I would have a lot more money in my account than I do today. If I was able to do that. I kind of blew the money, high school, college years,
Like
right?
any of us.
But if I could go back, right, that money compounded over the past 10, 12 years would be a lot more than I have now today. So
10-12 young guy.
yeah.
Yeah, I mean, similar, right? I think back even prior to going to college, and I've been blessed to make decent money throughout my sort of working years, and prior, even when I was sort of just doing some regular stuff. I busted tables for a while. I was basically a assistant to grad students at Miami, where I went to school in the engineering department. And I always made some money, but yeah, it was very easy to spend, right? Your priorities are just different. Like, oh, I got so much time until I'm older. And I would have definitely set something up that was systematized into an IRA or some sort of life insurance policy, or both. If I just had sort of the pre-knowledge I had today, set something small up, because the compound effect of just doing something consistently for a long period of time is insane.
Yeah.
That's why all my children have things going for them, right? They're so young, but by the time they're of age, they'll have tons of money in their name, more than way more than I do, right?
All right, so I wasn't going to go here, but since you said it, just real quickly. So if, let's just say, you do have a family, you have kids, and you haven't started a retirement account for them, that's something you can start at any point, right?
Yeah. Yeah, as long as they got a social security number, typically.
Yeah. And well, the biggest thing there is, if you have your child working in the business and they have earned income, you could look at doing a Roth IRA or a traditional IRA. Some of the biggest mistakes we see is people just, their child isn't working, they don't have earned income, and they open a Roth and contribute to it.
Mm-hmm.
You really need to have earned income.
Obviously, make sure they're filing some of your paperwork, and
at least, definitely consult a tax professional with that type of thing for kids, because, we don't want any clients to run into issues. If you can talk with your CPA or tax attorney and work out, okay, this makes sense, then by all means, we help clients with a Roth IRA for their kids that are under 18 years old.
Okay.
But other than that, if you're 18 years old or older and you're working, you have earned income, you could do a Roth IRA.
There are options with 529 accounts and updated rules for rolling that over later to Roth dollars. Life insurance doesn't have that same working necessity. So there's different aspects of those that could make sense for somebody's child to have.
Okay. Awesome. But yeah, so look, the reality is, if you're not saving for your future, you can find yourself in 10, 15, 20, 40 years in a very bad place financially and struggling to figure out what you do now. So the goal of having this podcast and having you guys here is to just really instill that in everyone that is watching this, that it's time for you to have that conversation with your financial advisor. And if you don't, Michael and Derek are more than happy to have a chat with you, and their information will be at the end of this podcast. But gentlemen, I want to thank you for your time, for your information, your knowledge, and look forward to, my pleasure. Look forward to growing wealthy together.
Yeah, man. I love it.
All right. Thanks so much, guys.
Thanks.